All right. Good morning, everybody. Day 2 of the vigil, waiting on FOMC. Today's kind of a big deal. We're going to get retail numbers. And as I mentioned yesterday, these numbers will not change the Fed's decision tomorrow, but they could change the market's expectations of the Fed's decision tomorrow. I know it's kind of convoluted. You got to walk around the tree to get to the other side there, but right now the market is leaning towards a 50 basis point rate cut, and it's one of the most fractured FOMCs that we've seen in a long time, where we really don't know what the Fed is going to do. And generally, we know at least half, right? There's two parts, well, four parts, but there's two that really stick out in the market. What's the Fed going to do, cut or not cut? And then what's their projections going forward? Generally, we know what they're going to do on the first part. We know they're going to cut. We know how much they're going to cut, or we know they're going to raise. We know they're going to hold. This is usually the part that we have a really good idea about. Markets have no idea. They're all just guessing. What we're seeing priced into the Fed watch is that the 50 basis point seems to be gaining traction. It's like 70-30 right now, 70% chance that we'll get a 50, 30% chance that we'll get a 25. But we still have no idea. For all we know, they'll punt again, which is, on the low end of the totem pole for probabilities, but they can still do it. They can say, now we're just going to hold here. I think that would probably set the market into a tailspin, but I think maybe a 25 basis points is going to set the market into a tailspin. We'll see. The market's expectation of the Fed's behavior is a big deal, right? Getting the numbers is one thing, but how the market responds to those numbers is a completely different thing. So just like with earnings, bad earnings can still send a market higher. Good earnings can still send a market lower, because the earnings themselves on a company is only part of it. Well, it's the same thing with the FOMC. So whether or not we get a 25 or a 50, that's only part of the issue. What they're going to do next, what their expectations are for continuing these cuts, and the timeline for the next cut, that's going to be a big part of it. And then the market's reaction to whatever's announced. And if the Fed does this wrong and makes it seem like they're chasing to get caught up, it won't matter what number they cut. 50 will send us down. 25 would send us down. But if they can project the confidence that they're not chasing, they're not behind the curve, and they can still put in a 50, that'd be like the Goldilocks sweet spot. So we'll see. Today, though, is 8:30. We're going to get retail sales, and it's kind of a big deal because it's going to go right to the heart of the market's expectation of the Fed's behavior tomorrow. It's looking really good otherwise, right? We had a nice run in the overnight, starting to give a little bit of it back now. Signaled beautifully with the cumulative delta, by the way. It's been kind of hit and miss with the cumulative delta, but it was just textbook perfect on that topping pattern this morning. Got to get it while the getting's good. We're going to get some data out of Japan tonight. We've got some data out of Europe for tomorrow that's likely going to shake things a little bit. But at the end of it all, it still comes back to retail sales today and then FOMC tomorrow. We're continuing to see some issues with the market maker move tag label. Like I'd mentioned, this whole week, we're going to see issues with that, with the rolling, the changing of the contracts. We do have a Fed speaker today. They're supposed to be in blackout, so any voting member is on blackout, but that doesn't mean that other members can't speak, especially if it's pre-recorded or if it's going to be someplace like a college or a university. If they're just talking theory, that sort of thing, and they don't, play their hand. That's at 10 o'clock today. You got Logan. It's worth keeping an eye on the clock, as I always say. Got the 20-year bond today. That's my baby. Keep your eye on the clock. These auctions, it doesn't show as high impact, but I can't tell you how many times I've seen the market make a radical change on the day right after we get an auction on the 10-year, the 20-year, or the 30-year. So either one of those three. And, I wouldn't dismiss the others, but we got our favorites, and I wouldn't sleep on that 20-year bond today. Drama. We're seeing Intel get some love. They picked up Amazon Cloud Services for a client, but it looks like it's going to be a client at their finished facilities, which they don't have finished yet. A lot of hopes and dreams built into that. So sure, Intel's looking good. It sounds like they're finally turning the corner there a little bit, but you can't make chips in a factory if you don't yet have the factory built. The end. All right, I mentioned the market maker move. We can see the label here. We do not know if that is a real hedge signal or if it's just because of the rolling. I'm going to believe that it's because of the rolling. We knew there was going to be a market maker move every day this week. So far, every day we've seen it. Of course, it's only day 2, but I'll take it. Until proven otherwise, meaning we don't see it disappear all day and it just stays there, then we're going to just assume it's the rolling. If we see it disappear, then we'll know it wasn't the rolling. It was actually because of the data this morning. Also, keep in mind what size it is. Some of this on the tag here could be hedging, and then the rest of it could be rolling. So if it, say, cuts in half, drops from 1.4 down to maybe 0.75 or 0.70, and then holds for the rest of the day, that'd be another signal that it was partially hedging and then partially just because of the rolling. If we measure yesterday's range from high to low and project that to the upside 50%, you can see we got there. It's where we started to build that topping pattern. We've rolled over now, headed back to VWAP. We have an average daily range of less than 75. Remember back in August, we were running at 101, 102. So our daily range has dropped considerably. That's a measure of volatility. Volatility is just a fancy nerd word for movement. And so when we move less, it implies that there is a lower volatility, right? That's kind of the base of it. The argument for the week was that we were going to hold sideways and wait for FOMC. That's always the base case argument, is that we'll hold sideways and wait on data. But I've shown repeatedly how we have this consistent move in the last few years where we've actually had Monday and Tuesday make moves into FOMC. So while we expect a market to not do anything into the data, that's not what we've been getting in the last few turns. There's a company called Edgefield that you can use for back testing a lot of that stuff. And they even have FOMC projections, right, on what the expectation is or what we've seen over X amount of time. I think they're using a 2-year period. We've got enough history from FOMC to have a pretty good idea of what the expectations are, but QRA is coming. I know it's kind of an obscure thing, but quarterly refunding. We'll have Yellen come out, start chipping her teeth. This happens 4 times a year. It's a cycle. It just goes again and again and again. We had one in August, well, late July, August. We're not going to see another one into the Halloween time frame, but it is coming. That's another thing we got to start thinking about looking forward. So we got close to the upper ADR today. It's very likely if we can break our own Globex high, we'll go ahead and take out that level and the cog line above it, 57.32. We're not expecting a continued run to the upside without data, right? We're going to get that retail sales data today. So it's likely that that data could put us through the ADR. If we get a little wild today, if you read the Spot Gamma founders note, you'll see they were talking about the VIX. There's an expiry coming for the September VIX options to trade. They're going to expire on Wednesday. And they were mentioning how there's some unexpected equity moves the day before the VIX expiration. And that today, the VIX movement will likely impact the S&P action. So not only do we have retail sales, and we have an FOMC Fed speaker, Logan, out there today chipping in their teeth, but we've also got this VIX expiration. It was in the AM edition founders note. If you want to go in, they had a couple pictures and talked about some moves that they saw on the VIX and the S&P yesterday. We do want to watch for breaking structure here. There's a history of when we get close to these ADR lines and then we don't hit it and we start moving the other way. We can retrace the whole thing all the way back down to the other side, 56.50. If we did that, we'd focus on our own Globex range first, get through our own halfback. That'd basically be 5,700. There's a cog line down here, 57.11. Then there's 56.92. Then getting through the halfback of yesterday. Then expanding outside of yesterday's range and getting down into that 56.50 area. In this market environment, we're going to get a lot of reciprocation around VWAP. It was one of the driving factors of yesterday that I was focused on. How far away from VWAP we are on one side and how much we get from VWAP on the other side. It's not a perfect science here, but this is like balance with VWAP in the middle, right? We just did what we were expected to do yesterday. Chop around VWAP. If we use VWAP as the mean or the central price, the average price, then we would keep revisiting that average and going above it and below it in balance. Generally in reciprocation, meaning whatever you got on one side, you're likely to get on the other side. Take that logic into today, and again, it's not perfect here, but you can just measure distance from VWAP, set it on the other side. It gives you a good starting point. We've already got levels, but if we didn't have levels, then we would at least have this to lean on. You can see once we start putting the levels in place, they're nearly evenly spread out, which is nice because we're just going from structure to structure. 57.11, the halfback, 5,700, 56.92, and then our own Globex low. And in between all of this is also that halfback from yesterday. Central pivot today is higher than the one from yesterday. The channels are really close to being the same. Today's channels may be a little bit wider than yesterday, but not too much, really a negligible amount. We have an MDP, meaning we have not hit that daily pivot yet, but it won't count until tomorrow. The fact that the channel opened above the previous day's channel is considered bullish, and the fact that price opened above today's pivot is also considered bullish. But the fact that we haven't hit that pivot still puts a shadow over today's price. Markets hit that pivot on average 80% of the time. So if we haven't hit it yet, there's still an 80% chance that we will. It's a nice way of saying it. When we consider distance from VWAP or distance from pivots, distance from moving averages, it's still a really big deal. So you always want to consider how far away from this thing are we, whether it's a moving average, a pivot point, a VWAP. If we can get above R2 this morning, then it's the chances of us hitting this pivot point drop drastically. But we have to get above that before the 9:30 open. So the clock is ticking. Keep in mind that more than half the trading day is already done. Yeah, I know. When I say that, a new trader always reaches out and says, I don't understand what the heck you're saying. The markets opened last night at 6 p.m. It's almost 8 a.m. So at 6 o'clock this morning, the day was half done. We're more than half done with the trading day already. It is worth noting how narrow the pivot lines are. So after we made a really big move back here, we can see how wide that range is. It's really big. But since then, we've had a lot of narrow days where we really just didn't do much. And so the distance on this range has shrunk considerably. Now all three levels on each side is contained in this small structure right here. Even just last Thursday, it was contained in this structure, and that's not even all of it. I would have to zoom the chart out, I think, to get the other level. No, I guess it was all three. No, there it is. That's a lot, right? It was this big on Thursday, and now it's this big. So getting above R2 on Thursday, that would have been a really big deal because it was so wide. Getting through R2 today, not necessarily all that difficult to imagine. We've gotten close to it. We just need to get through it, get above it, and hold that into the open. If we don't, then it leaves on the table a retrace back to R1 and then a retrace that continues back to the pivot point. We're nearing the end of this structure here. $57.27 is the highest point on that. And we're at $57.22. Pretty darn close. So if we can get through that structure, then we can look back into like mid-July. We've got some levels back here that may be of interest. Just remember that those contracts that were used to trade in July, we're not on those anymore, right? Just like we're not on any of these now, or at least we won't be very soon. But we're still in the roll process. And I think at this point, they would still be valid. If we were looking at March levels, maybe January's levels, you could make the argument that it's just too far in the past. There's no trader's remorse, unfinished business, or any sort of language like that. But July, still close enough that even if we are looking to roll into a new contract, or most of you should already be in the new contract, that level, even if it is from the old contract, still has weight, still has merit, value. We want to pay attention to it, know if we're going to hit it. It's not an odd number either. It's 57.50. Makes perfect sense. It's an options level, which is another reason to believe that we're going to see a response there if we can get to that number anyways. We are above the volatility trigger, the zero gamma level, the put wall, and the call wall is well outside of our expected range for the day. We're above all the major moving averages, so there's nothing here that we could hit to the upside other than that pivot that I pointed out from mid-July. That's the only thing to the upside left to hit other than structured measured moves like ADR and projecting 50% and 100% of our own price action to the upside. It's the only thing out there. Volume's twice as much as yesterday. It's not really saying much. And it still goes to the heart of the idea that they're rolling anyways. There's a lot left to be desired when it comes to figuring out, you know, new positions, old positions, rolled positions. Volume is just generic, right? We need more clarity on the kind of volume that we're seeing. But we'll take what we can get. This number being elevated kind of throws more support to the idea that the market maker move we're seeing is just because of rolling and not because of hedging. Generally, we wouldn't expect them to hedge and trade both. We've seen it, but we don't generally expect it. Yesterday, when we looked at the volume between these two contracts, the expiring contract had more volume than the active contract. That's not the case now. We're already turning the tide. and seeing more volume on the new contract and less on the old. We won't move the point of control unless we drop back down below 5,700 and build that level out more. If we don't do that, then we're not going to see the point of control move anytime soon. We're not building out any volume at our new level, and there's nothing that's going to wipe this off the table until we start getting into Thursday and Friday and we see these candles disappear. Once that happens, to get us into Friday, we could see the point of control move up by default into this location here. That'd be that 5692 cog line area. It's a nice structural level. It's possible that it drops down here, but I don't think it will, especially if we can retrace into this zone at least one more time, then we'll have the point of control at our feet. It's a really good place for it to be as a springboard to continue for more. Otherwise, if it rolls up here and we're on the underside of this, it'll start to act as a resistance. No point of control to carry forward from yesterday. We've already cut through that level multiple times. We are continuing our expansion to the upside here. They're not waiting on data. The carry trade was falling out of bed this morning, so a little bit of a warning on that. We look at these charts and what stands out is one of these things is lying here. I don't know which one, but one of them is lying. We've got a discrepancy also between the TPO and the volume profile's point of control. More trades took place here, but we've got more volume here. It's a little micro cup. And then a breakout puts us into liquidity. Expect opposite candle color now that we've made it to 1, 2, 3, 6. Once that happens, you can move the structure, change the drawing, or just add your next level. And just continue to do that, even in a small leg like this, without having to do the same kind of measurements we do on yesterday's high, yesterday's low. You can do it just as easy right there. All right, this is shaping up to look a lot like the other FOMCs, right? We showed examples yesterday where we started out with a sideways Monday, kind of staying inside of Friday's range. Tuesday, we expanded, and then Wednesday, we continued that expansion. It looks very similar to all of those. So far, we're right on track. Not necessarily that it's red or green, right? Just Monday, we held the line, stayed inside of Friday. Tuesday, we started to expand and continued that expansion into Wednesday at FOMC. Looking at things that are up this morning. What's up? Bitcoin, more Bitcoin, China ADRs, semiconductors through the SMH, tech, Mag 7, more China, uranium, more tech. On the one hand, it's kind of what we need, right? If you're going to get a rally in the markets, you got to have the Mag 7. You got to have, the consumer discretionary and technology, communications, financials. You need those. But on the other side of that, all of this resurgence of the short coverings, right? We've seen that yesterday, a lot of short coverings coming back up, forgotten names into beat down spaces. The utilities and healthcare staples, we're not seeing those in the list this morning. Now, on the one hand, it could just be flows, right? But they're not known for their pre-market trading. They don't have a lot of flows. That doesn't necessarily mean that they're not going to perform today. It's just the concern or the worry of the capital rotation and the lack of rotation on the other side of that. We do want to see the Mag 7. Yes. We want to see the Mag 7, participating. But we've all been looking for more than just the Mag 7, right? We don't want to continue to see this market get carried by those 7 names. We want the other 493 to participate. We can see Japan stuck underneath this moving average. The dollar is still testing lows. Looks like it wants to try again to get under 100.5. Getting outside of 100 to the downside is certainly something I think the markets are going to feel. We got the 2-year down at the lows, holding structure, and VIX at the lows. I can't show the carry trade on Thinkorswim. It's just wonky, just like TNX. Right? It's just an issue. So got to go back to Trading View if you want to see it. It's peso versus yen. This is a risk off behavior. This is concern and worry, but we're not seeing that in the S&P when we are continuing this expansion to the upside. And if you look at the cumulative delta on the overnight, that little bit of a pullback is nothing. See if we can get a picture of it. I can show you. It's on my other computer. I run two computers at once. Yep, that'll do. So up top here, this is the ES. Down below, this is cumulative delta on the ES. You can see when we pulled back, I had put in the chat, careful on that pullback. Cumulative delta wasn't validating that. It wasn't dropping enough. Right? We had bullish divergence on the cumulative delta. This is a 5-minute chart on the right side. White line is VWAP. And you can see that we barely pulled back during that drop. So it wasn't a hard stretch of the imagination to consider the idea that we were going to continue this move to the upside. We got to use what we have in a time like this, right? So any tool that we can that'll help us better gauge the price action that we've got in front of us. Cumulative delta is not always useful, as I'm sure most of you who's used it know, but when it's working, use it. Take advantage of it. We don't have anything showing here yet, but this will start to move pre-market. This is a ratio chart, IWF, IWD. It fell out of bed yesterday, so definitely want to keep your eye on this, see what it's going to do. Bullish in this would be bullish in your Mag 7, S&P, NASDAQ. That's oversimplifying it quite a bit, but just keep it simple, right? There's no reason to get complicated this early in the morning. Otherwise, you're stuck watching the news, and there's a lot of news to watch for. Don't forget that auction at 1 o'clock. Be careful, be safe. See y'all tomorrow.